Private sector economists have cut Singapore's full-year growth forecast. That's in line with the country's Trade and Industry Ministry's downward revision to 1.5 to 2.5%. With Singapore's first quarter GDP growth at 1.2%, economists also expect stabilising economic conditions to boost that growth later this year. Michelle Teo explains.
Global economic uncertainties have slowed down demand, and it's made an impact on Singapore's economy. The country's manufacturing, wholesale and retail trade sectors have all contracted, which led to a lower than expected first quarter growth. It's also the lowest quarterly expansion since the second quarter of 2009. The Department of Statistics also used a new benchmarking method to calculate the GDP.
In light of this new set of data, essentially, the set of series data that we base upon in our forecast, that our model based upon, has now changed so significantly. So henceforth, this warrants, a revision to our full-year forecast as well. We are now looking at 2.1% GDP growth. This is a downward revision from 2.6% previously.
Sectors such as finance and insurance, information and communications have helped support growth. These are expected to be the economic drivers for the rest of the year, along with education, health and social services sectors. However, some economists say these industries may have limited impact.
Their share of GDP is fairly small. For education and healthcare, you're talking about 2+% of GDP each, and then for ICT, maybe about 4+% of GDP. So in total, these three segments together is not more than 10% of GDP. So I don't think that they can replace some of the downside risks that we are seeing coming from the trade side or the manufacturing side, but they do provide a little bit of a support buffer.
But analysts say the worst may be over. They believe the stabilization of global risks may bear fruit in the second half and support economic expansion.
First quarter this year will still be the weakest at 1.2%. In the second quarter, you will start to see some marginal improvement. We are looking at potentially about 1.7% to 2% kind of level. But towards the second half of the year, I think partly because of the low base in the same period last year, you can expect the headline year-on-year number to be above 2%.
We still have significant fiscal ammunition in the form of accumulated surpluses. So I guess in the silver lining to all this is that if there is a need be, actually there is room for a fiscal response, whether it's in terms of off-budget measures or in terms of a more expansionary budget at next year's 2020 budget.
On a quarterly basis, the economy expanded, reversing the contraction in the previous quarter. It is also higher than the official forecast.